The beautiful aspect of money are stocks and bonds. I've invested in stocks through mutual funds. I've not done it individually. Bonds are another important thing. They're as old as money. That's how people raise money. Pavan, where do I begin when I talk about bonds and stocks? The very nature of today's world. We talked about, in the previous two segments, we talked about fiat currency, the gold standard, silver standard, briefly. But they need to know that money is also raised money through stocks and bonds. And everything has got to do with financial innovation all the way, correct, in the 16th, 17th century by the French and the Spaniards and the Americans. Talents. They were called talents at the time.
The Italians.
The Italians also. There was some, I think there were many names to bonds. They were called argents. There were so many other things. There was a guy, I think I must have got the name wrong. Perhaps I'll put it on the description. There's a French priest who invented a sort of a bond, right, just before the revolution in 1789. So let's go into the subject of bonds, because at Mentors for Kids, we want to demystify money. And if you got this far, you have to like, subscribe. We've talked fiat currency, we've talked gold standard, silver standard. Now we're going to talk stocks and bonds. Let's start with bonds. Most of our people hear about bonds where in papers, newspapers, whatever digital publication they're reading, or even their masters or teachers teaching them in class. Well, how do bonds work?
The fundamental difference between a bond and a stock or a share is that a bond is a debt. It is a liability that needs to be repaid. Stocks are ownership. It's a unit of capital that you own in a company. Let's talk about bonds first, right? Now, bond is money. It's a liability to the holder of the bond. Now, for example, if I have issued bonds to you, you've invested in my company, or you've invested in the government, or you've invested in some entity which has issued these bonds. This entity needs to repay the bond to you someday.
Correct.
That's the whole idea of a bond, right? Now, bonds again can be based on a period of time, 6 years, 7 years, 10 years, 15 years. You also have perpetual bonds. You have zero coupon bonds. You have different kinds of bonds, and these bonds give you a rate of return. It's a coupon rate, or it's interest, basically. That is the return that you get as an investor. So, for example, if you go to the RBI's website, the RBI hosts all the bonds that are issued by various government bodies, central government, different kinds of state governments, and you get a fixed rate of interest on the bond that you invest. Bonds can also be traded. So you have a secondary market. So if I have subscribed to a bond which is issued by a company or the government, I can take that bond, I can go and sell it in the market. So I can release my capital. So bonds have evolved over a period of time. Bonds, the perpetual bond, the whole system, and it's written the forward of the document to be very interesting.
Of RBI?
No, the forward of the book that we're talking about, David McWilliams.
Yes.
It's very interesting. It says that imagine an instrument that you'd be willing to invest in, which is perpetual in nature and that you'd never get repaid.
Which is what I want to ask you. This entire segment we're doing is inspired by this book called Money by David McWilliams. And we're doing this because it's important for
beyond the text,
for any human being to know this. And so, okay, bonds, it's interesting. People used to go to war. And even today, when nations go to war, they issue bonds. Correct? Let's start with that, because in the 16th, 17th century, it was great expansion into the new world.
Right.
So they first linked land and they issued bonds.
Correct.
Because they knew the value of land would go up.
Correct.
But then the value of land could also fall because too many bonds were I should have published. What are they called? Issued is the right word. Pardon me. See, I'm learning my financial parlance. So too many bonds were issued, and the value of the land would fall, and therefore the value of the bonds would fall. So let's link it to current times. So a bond is issued at an interest rate. Say, 100 rupee bond, which means I have paid 100 rupees, and I get 10% as a coupon rate by the end of the year, which means if I've kept it for 1 year, I get 10 rupees by the end of the year as interest.
Correct.
You're also right. It can be traded.
Correct.
I can take it and sell it in the
Correct.
markets.
Yeah.
In the bond markets. And that is where the concept of yield comes in. And the concept of yield, ladies and gentlemen who are studying BCom, very important to know that interest rates and yields are something that you keep. That's the difference between the two is where the profit margins are.
Correct. So they are both expressed as percentages.
Yes.
But the difference is interest is the absolute number that you're. So in your example,
So I got 10 rupees.
So 10 by 100 is the interest that you earn.
Correct.
10%.
Yes.
Yield is very different. Yield is calculated on the market value of that bond. So, and that is, let's say in your example, 10 is the interest that you earn, but the market value of the bond could be anything.
I paid 100.
You paid 100, but when you go to sell it in the market,
it could be 200.
It's not necessary that you get 100. You could get 110, you could get 95.
Or it can vary.
It varies, right? So the yield is 10 rupees divided by 105 or 110 or 95, right? So that gives you a very different percentage. So there's a difference between the coupon rates that you earn and the yield. Now, of course, the question comes, why would a bond trade at a different value in the market? And that goes back to the previous segment, where you also link this to the market rate of returns, which is determined now by the central bank. For example, if you're getting a 10% rate of interest on a bond, but the rate of interest that is running in the market is 9%, of course, your bond is far more valuable, right? People would run after you and say, you're getting 10% on this bond, but if I were to invest money in the government today, or if I had to put that money in a bank today, I would get only 9. This is far more valuable.
Yes.
Let me come and buy this bond. I'd be willing to pay you more than 100 rupees. Let me pay you 105.
Correct.
And you will sell it to me at 105. But the interesting bit is 100, and when it moves to 105, the interest is not going to change. Interest will still be 10. But 10 divided by 105 is no longer 10%. It will drop below 10%. It will go closer to 9.5, 9.6. So you'd see that there would be a general trajectory from 10 to 9, which is the market rate of return, right?
Yeah.
So over a period of time, the arbitrage
between the yield and the interest.
Correct. They are going to, let me say, there is a point in time where they are going to come together, where the interest rate and...
Would you call that an inflection point?
Not an inflection point. They're co-terminus, so to say, right? It's a point where they will join, because you cannot have an arbitrage where you have 10% coupon rate, 9% market rate, because then the bond becomes valuable.
Yeah.
When it becomes valuable, it will be sold in the market for a higher value. When it's sold at a higher value, the effective return that you get will be closer to the market rate of return.
Okay.
So that's naturally going to happen.
Okay. Why do investors... See, a lot of people, kids would be thinking, okay, one bond costs this much, so will I make any money? We are talking about people trading in trillions.
Yes.
Right? At that trillion value, they look at yield and interest rate.
Absolutely.
And that is the margin, right?
Correct.
And that is where they try to make profits or book profits.
Correct.
And some people lose money also.
Correct. Yeah, and it's a matter of few decimals.
Yes.
Right, where you make or lose money. Of course, the markets are massive, right? The debt markets, we call it the debt market.
They're larger than stock markets sometimes.
Apparently, because you're trading in huge volumes. The government is involved. Sorry, the government at various levels are involved, right? Because central government's involved, state governments are involved. And like you mentioned earlier, maybe governments would issue bonds when they go to war.
Yes.
Today, governments raise money through bonds to cover their deficit. Fiscal deficit is...
So the roads, the new roads that you see...
It's all through bonds.
Andhra,
Karnataka, I don't know. I hope we see new roads in Karnataka.
They raise it through bonds.
They raise it through bonds.
Companies also.
Companies too. Now that's an interesting segment, right? Companies also raise money through bonds. Now, company is an entity by itself, which is promising to repay this money, but it needs to be backed. Governments will issue bonds, and the backing is their promise. You, of course, won't expect the government to default. Private companies can default. So you need something to back this bond, and which is the underlying security. The security could be an asset, piece of land. It could be assets, which could be machinery
of the company.
It needs to be backed by a security. So these are collateral. There should be some collateral, and these are secured bonds. Versus unsecured bonds, where there is nothing backing the promise except for the company's promise. There's something called credit rating, and credit rating is mandatory for any company that wants to go public with its bond issue. So you have credit rating agencies, which are independent parties, who will validate what is the company, right? So basically,
to issue before they issue bond.
Before they issue bond, right? How confident can you, as an investor, be in that company? The bonds can be AAA plus, AAA, AA, B minus, so on and so forth. Each credit rating agency has its own metric by which they value these bonds, value the company. So the higher the rating, the greater the confidence in the entity issuing the bond.
That
Right?
your money is guaranteed.
So for anybody who's investing, please look at the credit rating as much as
Of the bond.
of the bond, as much as you look at the interest rate.
Okay.
Because just because the bond is giving you 14% interest doesn't mean that you get 14% if the company itself will default.
Quickly, interest rates of the RBI have a bearing on bonds,
Absolutely. So if the
whether
interest
they reduce it or increase it.
Absolutely.
So that's what I wanted.
so the repo rate, so to say,
Yeah.
if the Reserve Bank of India is increasing or decreasing these repo rates, it has a direct impact on the deposit rate that a commercial bank is going to offer you. It has a direct rate on you as an investor because, say, for example, if you were getting 7% rate of interest from a bank, fixed deposit,
Fixed deposit.
why would you go and buy a bond from a company which is higher risk? And if the company gives you, let us say a company is issuing a bond at 6%, but you have the largest banks of India giving you a fixed deposit at 7%, who in their right mind would go and buy that bond at 6%, right?
Correct.
So those companies will have to issue bonds at a much higher rate. You also have to appreciate that.
So maybe they have to beat the banks.
Actually, not just the bank. They also have to beat the central government. They have to beat the state government.
So if the RBI raises rates, they have to make their market rates competitive.
100%.
That's it.
And there are 4-5 layers, right?
Okay.
Central bank, commercial bank. You also have central government, state governments. State governments have to offer a better rate of interest than central government.
Okay.
And now you have listed companies, PSUs, then private companies.
Right. Right. This is beautiful, guys. You have to understand commercial paper is a bond.
Yes.
Fixed deposit is a sort of a bond.
It's sort of a,
Okay. Companies can issue bonds. Governments can issue bonds. State governments can issue bonds. Everything regulated by the central bank. Again, by decree.
Yes.
It is a sort of a fiat money, but it's a debt.
Yes.
Right? Now, in America and China have a relationship with something called IOU. Quickly to our students who will become managers of treasury, they enter banking, they will also manage companies. What is an IOU?
So IOU is
IOU, literally.
literally, yes, right? It is maybe an overarching term which you'd use for promissory note.
It is a promissory note.
It is a promissory note. Basically, it is money that, like I said, bonds are debt. When you invest in my bond, I owe you the money back at some time in the future, right? So that's how the IOU concept evolves. But of course, when it comes to nations, bonds that are issued by government can be bought by other countries. So today, US bonds, the largest holder of US bonds is China, which is why to a large extent, China does have leverage over the US economy because they hold bonds. They have the power to junk these bonds in the market at less than their market value. So once the value of these bonds start dropping, you will see a domino effect on the US economy because the world is interconnected. But maybe that's a conversation for a separate day, right? But IOUs, promissory notes, are bonds. These are debts that are owed by one government to another.
You know why I didn't talk much about stocks? Very simple. You want to invest in a company, you invest, you get equity in return. The company might fail, you may not get the money back. If it grows, you get it in X terms. Maybe you invested 1, it can become 10. That's as simple as stocks, correct? But its origins lie with something called a joint stock company. Now I'm going from bonds to the corporations, the joint stock companies, which basically figured out that, okay, we don't need bonds. We can raise money from the public by giving them something called equity or stocks, correct?
Yeah. So very interestingly, the origin of the joint stock company has its origins in the Europe because of the ability they were shipping nations, right? Shipping is a risky business. Now it was very risky earlier. Why should one individual take the risk? How do you de-risk yourself? So they set up joint stock companies.
Pool the risk.
Pool the risks, right? So you'd have 100 people coming together and say, I have de-risked myself by 100th, right? There are other people who've joined. Now we have enough money on the table to take up this expedition, right? So it was a way by which investors would de-risk themselves. It is also a way by which they will make a lot of money. See, the gap between bonds and stocks. As a stockholder, you are part owner of the company.
Correct.
It means that the return that you get is on the profits that the company makes. Higher the risk, higher the return. That's the fundamental philosophy in finance. Bonds, secured bonds, low risk, low return. Unsecured bonds, slightly higher risk, higher return. Stock, very risky, very high returns, right? So extremely high returns. Also, very interestingly, when
all of them can be defaulted, including bonds.
Absolutely.
People may not even pay the interest.
Yeah,
the yields may also fall.
It can. So I'll go to an episode in our own state, city, painful episode, the National Cooperative Bank, highly respected entity, highly respected bank, defaulted, right? So
in the payments,
yeah. So
bonds
defaulted, right?
of interest
so
payments.
its shares have no value.
You're talking in terms of the stocks also and
stocks and bonds, right? It loses value.
Both lost value.
Both will lose value, right? So yes, they can default. But think of it this way. In your mind, the government of India is never going to default. The government of Karnataka is never going to default. Why? Because they, going back to the first segment, they are the ones who come up with the decree to print money. They will not default because they'll print money, right, to cover their defaults. Or they will issue new bonds.
Yes.
So the whole idea of bonds.
To make it lucrative.
Yeah. So for example, today if I have to repay you as a bond holder, the bond has matured in 2025.
Yeah.
I'm not going to pay you in cash. I will go and issue new bonds. But these bonds are going to mature in 2035. So you pay me money, I will pay you money, right? It's just circular.
So interesting. I may not be able to cash out.
You will cash out as an investor. As the government, this is a hamster on wheel, right? It will just keep running.
Yeah.
So the money that I have to give you will come from somebody else's pocket. And I am going to defer the promise of paying money in 2025 to 2035.
But I might have cashed out as an investor.
You cash out.
Yeah.
For the government, money keeps circulating.
Because they have to run it that way.
So the whole idea of mortgage bonds. So the word mortgage, mort also comes from death.
Death. Mort in Italian means death.
Yeah, death. So the whole idea is that this bond is related to somebody dying, right? It will be paid when you die, so to say. It's always going to live. So you get your money and you're out. That this bond is just going to live.
Okay, quickly. Say government of India issued a 30-year bond in 1995. It's coming June 2025. They would have paid their investors?
Yeah, but they'll pay by issuing new bonds that will mature in 2065.
To the investors?
Absolutely, I'll invest.
Or some other new investors.
Will invest.
So basically they have new people coming in, or even the old people, older investor can participate.
Correct. So the money just circulates.
So bonds are perpetually
in a way, right? Because
so they are settled.
They're settled. They're settled every year by new bonds being raised. But that's bonds, right?
So governments also have to manage that. It's part of that balance sheet
100%.
kind of management.
100%. Right? So very interesting. If you look at the budget of India, you'll see all of this information. But back to the joint stock company, right? The stocks. So stock is ownership. Now, stocks can be traded in the secondary market. In addition, that's the BSE, NSE, the markets that we see. But you also see IPOs with the public offers, money being raised for the first time.
Yeah, private money.
Private money, right? So, VCs, that's...
Venture capital.
Yeah, that's a whole new chapter by itself, right? So, you have companies. The joint stock corporation can be either a public entity where its shares are being traded in the public.
Correct.
Or they are privately held entities where it's owned by a few people, right?
Which basically means the IPO is regulated because now it's regulated by government. That is why you're called a public company. You raise money from the public and the government guarantees that your company doesn't fail.
Not the government.
Not the government, pardon me, the regulator.
The systems of
the regulator, the SEBI.
Because the penalties of defaulting are so high.
So the regulator in this case? SEBI, right?
In India, yes, it is SEBI. But very interestingly.
And under the SEBI are the BSE, NSE.
Yeah, so basically SEBI is the regulator. Right? Yeah. So, and the penalty to default is so high that you better not default, right? Because you'll be imprisoned if you were raising this money by making false promises. But very interestingly, joint stock companies, think of it. You are a very wealthy individual.
Yes.
You floated a company. Now you've also floated the shares in the market. So these are individuals who may not be as wealthy as you are, but now who are part of your company as shareholders. But think of it. These individuals are as invested in the company's future as you are.
Yeah.
So you have de-risked yourself to a large extent because these are individuals.
Yes.
Now there's also a motivation to go and buy your own products, right? Because the more money you make,
the more money I make,
I'll go spread the word. So as somebody who's very wealthy, you have de-risked yourselves a lot by getting the public involved in this whole process.
So that is where the VC concept quickly comes in.
The private money.
In the private money segment, you can go start your own company, convince people to invest in a few clutch of investors, and you increase your value.
Yes.
So somebody else will come and buy them out.
And you de-risk yourself as a promoter And that's the whole idea, right?
And that's also called creation of.
Correct. And that goes back to your forward. Money gives you a lot of freedom.
Yes.
Money gives you the ability to innovate if you have enough money.
Yes.
So if you're able to de-risk yourself, it is good because you're able to think creatively, right? So money gives you the freedom to innovate.
So therefore, that ends our chapter on bonds and stocks in a very simplistic manner. We are encouraging you to read. Go read about money.
Yes.
Not self-help books that will increase this, will increase that. Know the essence of where it begins. We covered fiat currency. We covered gold standard, silver standard. We've covered bonds and stocks. Now I want to talk about international settlements. A slight segue into what happened to India in 1991 and how we opened up the economy from being a socialist state to a combination of socialism and capitalism, which we want to discuss further, because I'm wondering, how do we manage it? Because it involves taxation, it involves international settlements, it involves the rupee and the rupee's value. The rupee appreciates, depreciates in relation to the dollar.
Sure.
I want to talk about international settlements. Again, like and subscribe. And I hope you understood money so far. If we've missed something, do let us know.
Yes.
We will answer them on the LMS for you. And again, this is Pavan Sharma and this is Vishal Krishna trying to demystify money with this book that has inspired us. It's by David McWilliams. It's called Money, A Story of Humanity.